from a cross-asset, multi-asset perspective, at Eastspring, we are maximum bullish equities at the moment against bonds. We still think that the increase in economic growth is not fully priced into the equity markets at the moment, especially within the value space. If you look at the deep cyclical sectors, we still think that there is quite a bit of room that can run. So at Eastspring, we are bullish on global equities, particularly U.S. equities, because the U.S. economy seems to be running at the fastest steam at the moment, and that is something that we think is the most attractive value at the moment. On the bond side, we still think that there is some room for yields to continue to go higher from here. It's something which will probably happen gradually, and there's a bunch of Federal Reserve speakers, speeches this week, which is going to be critical for the direction for the bond market.
Just picking up as playing the devil's advocate here, Nupur, why would you prefer US equities over EM equities right now, considering that US markets are already at record highs? And as the economic data, as you are suggesting, does continue to get better, won't that actually be something that potentially weighs on the stock market, which is exactly the trap that the Chinese mainland markets have got into, where every time they get a good data point, the stock market considers this as a step towards policy normalization and therefore a negative?
Yeah, Mandy, that's a good question. I think, from a U.S. equities perspective, yes, economic data is improving, but it's really the easy monetary and fiscal policy and the support really from the policymakers, which to our mind is going to keep the U.S. equities from rising, especially against EM equities. Within emerging markets, really, if you see, there are pockets of weaknesses which are coming due to idiosyncratic reasons. In China, as a result of slight tightening in policy or the policy stance, and then the resurgence of infections in Brazil and India, all of these little idiosyncratic reasons we think are potentially likely to keep emerging market equities as being laggards. Also, if you look at earnings expectations by analysts on the street, your U.S. earnings expectations and revisions are still outpacing those of emerging markets. So we think that each of these reasons really does keep the U.S. equities still on a strong footing, even though the valuations appear as being quite expensive.